Welcome back to Trading Lessons from Legends. Every trader learns how to enter. Few ever learn how to survive. Jesse Livermore did both. He built empires when others went broke, not because he was smarter, but because he mastered one secret rule, the rule of position sizing, the rule that decides who lasts and who disappears. Livermore called it his invisible edge, the law that made him rich, and the same one he broke before losing it all. Tonight, we'll uncover how this simple idea, how much you risk when you're right, and how little when you're wrong, still decides every trader's destiny 100 years later. Because intelligence might make you money, but only discipline will let you keep it. Let's begin. The hidden edge. Why size decides survival. Jesse Livermore once said, "It's not the market that beats you. It's the size of your bet." End of teens. Most traders think they lose because they read the chart wrong, entered too early, or didn't predict the news. Livermore knew better. He understood that most traders don't go broke from bad ideas. They go broke from good ideas sized badly. The invisible skill no one talks about. When people talk about Livermore, they talk about his genius, his $100 million profit in 1929, his timing, his tape reading. But few realize that the core of his survival, the quiet pillar under every one of his triumphs, was position sizing. To him, position size wasn't a number. It was philosophy. He believed that a trader's success has less to do with how often he's right, and everything to do with how much he risks when he's wrong. Even a fool can be right sometimes, he wrote, but only a disciplined man survives being wrong. That was the secret edge almost no one saw. Livermore's real weapon wasn't prediction. It was proportion, the first lesson of survival. In the early 1900s, he would watch men at the stock exchange make small fortunes, then lose them faster than they were made. Same intelligence, same strategy, but one difference. They didn't know when to stop increasing size. He saw it happen again and again. A trader wins 5 times in a row, feels invincible, doubles his position on the 6th and loses everything. Livermore studied that pattern like a scientist. He concluded that markets don't kill people, leverage does. He wrote, "Markets can forgive bad timing, but they never forgive bad sizing." That sentence, written a century ago, is still the most expensive truth ignored by traders today. The illusion of intelligence. Livermore noticed that traders often confuse being right with deserving to win. They think intelligence guarantees safety, but the market punishes confidence that isn't quantified. He said, "When you trade large because you feel smart, you're not trading, you're confessing arrogance." He'd seen the smartest men destroyed by their own brilliance because they bet in proportion to their pride, not to probability. To Livermore, position sizing was humility in numbers, a way to remind yourself that even when you understand, you can still be wrong. The logic of survival. He divided all traders into 2 types, those who trade to be right and those who trade to stay in the game. The first group dies young. The second group gets rich slowly. He belonged to the second. To him, capital was oxygen. Each position was a breath. He didn't need to inhale everything at once. He just needed to make sure he never suffocated. He said, "If I lose my capital, I lose the right to be intelligent tomorrow." That's why he sized small at first. Not because he feared loss, but because he respected longevity. The arithmetic of longevity. Livermore kept a simple rule. Never risk more than 2% of total capital on any single idea. This wasn't superstition, it was math. He knew that even with a 60% win rate, too much exposure could lead to ruin through variance alone. He treated risk as a mathematical organism, a living thing that multiplies behind your back, if not contained. He once told a young trader, "If you size too big, you're not speculating, you're praying." And in Livermore's world, there was no room for prayer, only discipline. Why most traders size emotionally? Traders think in emotion, not numbers. When they're scared, they shrink their size. When they're euphoric, they expand it. The exact opposite of rational behavior. Livermore inverted that logic. He sized larger only when the market proved him right. He called it adding confidence through evidence. If he was wrong, he cut. If he was right, he grew, but slowly, mechanically, like building a tower only after the foundation was tested. "My job," he said, "is not to make money fast. It's to survive long enough to let money compound." That's position sizing in its purest form. the art of staying available when others disappear. The market's favorite predator. Livermore viewed markets as predators that feed on extremes. They don't punish ignorance. They punish overconfidence. When you trade too small, the market ignores you. When you trade too big, the market eats you. The goal is to stay in the middle, visible enough to matter, invisible enough to survive. He compared it to hunting lions. A hunter doesn't fight the jungle. He waits for the right distance. Not too far, not too close, and then fires once. Position size is that distance. Get it wrong, and even perfect aim won't save you. The psychology of scale. Livermore noticed something subtle. The larger his position became, the smaller his objectivity grew. Each added share increased not just his exposure, but his emotional weight. He wrote, "When your position becomes too large, you stop seeing the market. You start seeing yourself. That's when traders make the fatal mistake, defending their ego instead of their equity." He used size as a psychological diagnostic. If it made him anxious, it was too big. If it made him careless, it was too small. Between fear and arrogance lay the perfect proportion, the hidden edge. So what exactly was Livermore's hidden edge? It wasn't timing. It wasn't even tape reading. It was risk calibration. He could watch 10 stocks move and only take one, not because he didn't see opportunity, but because he knew how much of himself to risk on each. He said, "A small position teaches, a big one tests, but only the right one survives." He saw capital as emotional energy, something to be preserved for the rare moment. When market, timing, and confidence align perfectly, that restraint made him unstoppable until he forgot it. The moment he forgot his own rule. Years after his greatest wins, Livermore began to break his own commandments. He increased position sizes beyond his tested limits. He chased conviction with confidence, not confirmation. He still had genius. But genius without restraint is a slow kind of madness. He lost fortunes not because his analysis failed, but because his sizing did. He later admitted, "I broke every rule I wrote, and the market reminded me who was master." That sentence could be carved above every trading desk in the world. The modern reflection. Today, traders have algorithms that optimize exposure automatically. But the principle hasn't changed. Your size still decides your fate. You can have the best edge, the perfect entry, and still lose. If you bet like you're invincible, the game doesn't reward brilliance. It rewards proportion. Livermore turned size into strategy, strategy into structure, and structure into survival. That's the evolution every trader must make, to outlast their own intelligence. The first secret of position sizing: survive first, grow second. Livermore's first rule wasn't about maximizing profit. It was about guaranteeing the ability to trade tomorrow. He saw survival not as fear, but as freedom. Freedom to wait, freedom to listen, freedom to act when clarity returns. Because in the end, the only traders who get to be legends are the ones who are still around to learn their final lesson. The pyramid principle: add when right, never when wrong. There was a reason Jesse Livermore called himself a scientific speculator. He didn't gamble. He experimented with himself as the subject. And one of his greatest discoveries came from a simple observation: you don't need to be right often, if you know how to build when you are. He called it the pyramid principle, the law of asymmetry. Most traders grow their exposure when they're losing, adding to a bad position in hope that the market will come back. Livermore saw that as emotional suicide. He said, "A losing position is like a wound. If you don't stop the bleeding, it becomes fatal." So instead of adding to losses, he built pyramids only on profits. He added when the market confirmed him, not when he needed the market to forgive him. That single shift in logic transformed speculation from guessing into science. The pyramid in motion. Picture it. A breakout begins small, quiet, believable only to him. He enters with a modest position, just enough to test the idea. If the market drifts in his favor, he doesn't rush. He watches. He waits for proof. A higher high, a sustained volume increase, a moment when resistance becomes support. Then and only then, he adds a little more. The market confirms again. He adds again. Each addition smaller than the last, like stones stacked toward the top of a pyramid, wide at the base, narrow near the peak. That was the structure that made him millions and protected him from ruin. The psychology behind the structure. Livermore understood that growth must slow as confidence rises. He compared it to climbing a mountain. You move fastest at the bottom and most carefully at the top. Each new layer must prove it deserves to exist, he wrote. He didn't treat profits as permission to relax. He treated them as increased responsibility. The higher his gains, the more disciplined he became, because he knew success invites blindness, and blindness invites reversal. That's why every level of his pyramid was smaller. His position grew in value, but his exposure to disaster shrank. The architecture of control. To Livermore, this wasn't merely a tactic. It was architecture. He built trades like cathedrals, foundation wide, walls precise, spires rising only when the base could bear the weight. He said, every position is a structure. Build it wrong and it collapses under your own excitement. Most traders build towers of emotion. Livermore built pyramids of confirmation. That's why he could survive trends that destroyed others. His structure made him anti-fragile, stronger as the market tested him. The discipline of incremental proof. He didn't believe in going all in. To him, that was gambling disguised as confidence. He believed in incremental proof. Each new entry had to be justified by the market's own behavior, not his prediction. He said, I don't add because I believe. I add because the market believes. That sentence defines the core of professional risk management. Let external truth expand your internal conviction, never the other way around. The mathematics of the pyramid. Livermore's pyramid followed 3 ratios. Base position. Small, 20-25% of intended size. 2. Second layer. About half the first, if the move confirmed. 3. Third layer. Smaller again, 25-30% of the second. The total exposure never exceeded what he could survive. If the trend reversed suddenly, he didn't chase perfection. He engineered survivability. He wrote, every addition must reduce my vulnerability, not increase it. That's how he turned compounding into a shield, not a weapon. Why most traders build upside down? Modern traders do the opposite. They start big to feel certain, then panic as volatility tests them. They shrink at the bottom, grow at the top, and call it strategy. Livermore smiled at that. He called it pyramiding in reverse, building to collapse. He said, I never double up to prove I'm right. I double up to prove the market is. That inversion, letting the market earn his trust, was his edge over ego. Emotional geometry of adding. Each layer of his pyramid had a psychological purpose. The first layer tested belief. The second layer tested conviction. The third layer tested discipline. He could feel his emotions compress with each addition. Less excitement, more clarity. By the third layer, he wasn't hoping. He was executing. That's how he turned emotion into structure. He didn't suppress feelings. He measured them. Every addition was a test of inner calm. The rule that saved him. During the bull markets of the 1,910 seconds, Livermore often sat on positions worth millions. And yet his rule never changed. Never add to a losing line. Not once. He'd cut instantly if the base of his pyramid cracked. He didn't negotiate with failure. He amputated it. He believed that the first loss is the cheapest, but only if you accept it quickly. That rule saved him more times than luck ever could. The power of scaling through proof. Livermore's pyramid principle isn't about greed. It's about synchronization. He aligned his growth with the market's conviction. He didn't demand momentum. He waited for it to appear naturally, then followed it like a shadow. This rhythm, wait, test, confirm, expand, was how he turned volatility into harmony. He called it dancing with the tape, the trap of impatience. He warned that most traders destroy pyramids by trying to build them in a single day. They rush to size up before proof exists. They treat confidence as evidence. And the market, as always, punishes arrogance disguised as ambition. He said, every trade must earn its right to grow. You can't promote a losing position into profit. To him, patience wasn't just a virtue. It was equity protection. The modern reflection. Today's market moves faster, but the principle remains identical. You still test, you still build, you still confirm. Algorithms can't replicate it because it's based on emotional sequence, not code. You add when your thesis and the market agree, and you stop when that harmony fades. Livermore didn't need indicators. He needed only awareness. And awareness grows in silence, not in speed. The second secret of position sizing: add when right, never when wrong. 5 words that separate operators from amateurs. When you add to a winner, you build truth. When you add to a loser, you build denial. Livermore's genius wasn't finding trends. It was building pyramids that could survive them. Each addition a prayer to logic, each reduction a confession of humility. That's what made him an artist, not a gambler. Reflection for modern traders. Ask yourself, when you add to a position, are you adding to proof or to hope? If your size grows while your confidence shrinks, you've inverted the pyramid. Livermore's wisdom still applies. Build slowly, confirm constantly, and remember that every extra dollar you commit is a vote of confidence not in the market, but in your own ability to stay disciplined. The pyramid in spirit. The pyramid wasn't just a structure of capital. It was a structure of consciousness. Each level represented a higher state of understanding, from curiosity to belief to mastery. By the time his position peaked, Livermore had already detached from excitement. He wasn't guessing, he was observing. The pyramid traded itself. That's what every trader should aim for. A position so well built that emotion can't touch it. Closing the second rule. The market rewards the man who grows with it and destroys the one who grows against it. That was Livermore's creed. He didn't build fast. He built correctly. His pyramids were silent monuments to patience, each layer a line of trust between man and market. And as long as he respected that trust, he was untouchable. The math of confidence. How Livermore quantified belief and controlled exposure. Jesse Livermore wasn't a mathematician, but his instincts worked like an equation. Every trade, every decision, every layer of his pyramid was measured by one invisible formula: the math of confidence. He believed that the size of a trade should always reflect the strength of conviction, and conviction should always be proven, not felt. He used math not to predict markets, but to regulate emotion, the ratio of risk and belief. Livermore treated confidence like currency. It had to be earned, not imagined. He wrote, "A man's belief in a trade should be expressed in proportion, not excitement." Oh, that meant no single trade, no matter how obvious, was ever allowed to threaten survival. If he felt emotional attachment to a position, he reduced it until it became boring again. That was his signal of balance. When the position size no longer triggered adrenaline, but discipline, he believed that risk was the geometry of emotion. If your heart rate doubled, your exposure was wrong. Measuring conviction in percentages, Livermore didn't use percentages for profit. He used them for protection. His rule was simple. No single position should risk more than 2% of total capital, not because of math, but because of psychology. At 2%, your brain stays rational. At 10%, it starts praying. At 50%, it stops thinking. He said, "Big positions make small minds." And his use of percentages was a shield against ego. It kept him from confusing bravery with recklessness. He didn't measure opportunity by how much he could make. He measured it by how much he could lose, without losing himself. The equation of emotional capital. Livermore understood something that most traders still ignore today. You don't just have financial capital, you have emotional capital. And emotional capital depletes faster than money. Every losing streak drains confidence. Every oversized bet accelerates that drain. When emotional capital hits zero, discipline follows. And when discipline dies, equity is next. He once wrote, "The greatest losses begin when a man risks money to restore his confidence." He used position sizing as a brake on self-destruction, a way to conserve both capital and composure, confidence as a curve. He visualized conviction as a curve, starting small, rising with proof, flattening with maturity, never exponential, always controlled. As the market confirmed his direction, he increased gradually, but each addition became smaller, because certainty grows while opportunity shrinks. He called this the tapering law. It kept him safe when the market turned euphoric. When others shouted, he reduced. When they panicked, he rebuilt. His curve of confidence was always out of phase with the crowd. The relationship between volatility and exposure. Livermore believed that volatility wasn't a warning. It was information. When markets grew erratic, he didn't fear volatility. He adjusted size. High volatility equals small exposure. Low volatility equals larger exposure. He understood what modern risk managers now call position elasticity. He wrote, "A man should never let market movement change his mind, only his size." That one line explains every major hedge fund principle today. He discovered it by intuition a century earlier. The danger of emotional leverage. He warned that even without borrowing, traders use emotional leverage every day. It's when you bet more than your discipline can handle. He said, "A man may own 100 shares, but if they own him, he is leveraged already." That was his quiet genius. Understanding that leverage isn't just about money, it's about attachment. He measured exposure not by dollars, but by how much mental space it occupied. If a position dominated his thoughts, he trimmed it, no matter how profitable it looked. Freedom of mind was worth more than unrealized gain. The emotional algebra of losing. Every loss, Livermore believed, had a mathematical purpose: to teach proportion. When he lost small, he felt gratitude. When he lost big, he felt warning. He said, "A small loss keeps me in rhythm. A big one means I've broken tempo." It treated losses like metronomes, reminders to slow down when the beat of the market changed. That's why he never averaged down. He believed that adding to a loser was emotional algebra gone mad, doubling exposure when logic demanded division, confidence without calculation. He saw that traders destroy themselves when they mistake emotion for confidence. True confidence, to him, was quiet and mathematical. It had ratios, thresholds, and structure. If a trader couldn't define how much he'd lose before entering, he wasn't confident, he was hopeful. Hope, he said, is the tax a man pays for not doing math. That sentence still cuts deeper than any modern textbook on risk management. When to increase, when to stop. He increased position size only when two conditions aligned. 1. The market confirmed his direction through behavior, not headlines. 2. His own emotions remained neutral. If either condition broke, he paused. He didn't let excitement justify expansion. He let consistency justify confidence. When the move became obvious to the crowd, he stopped adding altogether. Because public enthusiasm marked the top of the curve, the point where conviction turns into complacency. That restraint kept him rich longer than most of his peers stayed solvent. The moment he violated his own equation. But as always, Livermore's tragedy began the moment he abandoned his own math. During his later years, he grew impatient. He entered large before confirmation. He sized based on memory, not math. He still had insight, but without proportion, his genius turned unstable. He once admitted in his notes, "I forgot that size decides clarity. I began thinking in millions, not in percentages." That was the slow undoing of a man who once turned arithmetic into art, the modern reflection. Today, every trading platform calculates risk automatically. But the math Livermore used can't be automated because it lived inside his judgment, not his software. He used numbers as mirrors. When they no longer reflected discipline, he stopped. He believed numbers were only as honest as the emotions behind them. And that belief gave him something algorithms will never have: awareness. The third secret of position sizing. Your size is your psychology made visible. Livermore's third secret was that confidence isn't shown in words. It's revealed in allocation. He didn't say, "I believe in this trade." He showed it precisely, mathematically, and modestly. Every percentage he risked was a sentence of truth. Every reduction was an act of humility. Every pause was a confession of uncertainty. He turned math into conscience. Reflection for modern traders. Look at your own trades. If your size increases with excitement, you're gambling. If it increases with confirmation, you're operating. Livermore's difference wasn't that he made more. It was that he understood why he deserved to make it. That understanding, the ability to quantify belief and control emotion, is what separates the trader who lasts from the trader who fades. Closing the third rule. The market is a scale that weighs conviction, not intelligence. That was Livermore's silent creed. He never let emotion define his size. He let truth do it. And that discipline, the fusion of psychology and arithmetic, became his unseen advantage, his invisible armor, and his most beautiful rule, the emotional geometry of risk. When psychology meets position, Jesse Livermore believed every trade carried two positions, one on the market and one inside your mind. The first could be measured in dollars, the second in emotion. He understood that the geometry of risk was not linear, it was psychological. Every increase in position size multiplied not just exposure, but identity. And that's where most traders collapse. Not from math, but from meaning, the shape of pressure. Livermore often compared trading to architecture. He said each position has a shape, a structure that either distributes pressure evenly or concentrates it until something breaks. A well-sized position feels like a solid bridge. Stress flows through it, but doesn't distort it. An oversized position feels like glass. It looks strong until vibration starts. He once told a friend, if a trade makes your heart beat faster, your sizing is wrong, not the market. He meant that the human body is the most accurate risk indicator ever invented. It signals when leverage turns emotional, the weight of a dollar. Livermore understood that a dollar isn't just a unit of currency. It's a unit of pressure. The more you risk, the heavier each tick becomes. He noticed that when traders increase size, their perception of price changes. A 10-cent move feels meaningless in theory, but terrifying when multiplied by thousands of shares. He said, a small loss in dollars is education. A large one becomes identity. That was his way of saying that. Money changes from math to mirror. The moment emotion takes over. The mirror of attachment. Livermore saw attachment as the most expensive luxury in trading. Every time he increased his position, he felt ownership creep in, and ownership breeds bias. He wrote, the bigger my line, the more I want to defend it, not because it's right, but because it's mine. That realization turned him into a philosopher of risk. He began sizing not to maximize return, but to minimize attachment. He used to cut positions preemptively, just to regain objectivity. He didn't call it a loss. He called it a clearing of vision, the geometry of emotion. Livermore believed every trader lives inside a triangle: fear, hope, and balance. Fear pulls one side, hope stretches the other, and balance sits at the apex, where awareness resides. Position size decides which force dominates. Too small and hope becomes reckless. Too big and fear becomes paralyzing. Only balance lets you see clearly. He said, the right size is where you stop reacting. End quote. That sentence may be the most elegant summary of emotional risk management ever written. The spiral of overconfidence. He saw overconfidence as a spiral. Each success slightly increases size. Each increase slightly amplifies ego until the geometry collapses inward. He called it the pyramid inverted. The structure meant to protect you becomes the one that destroys you. He wrote, when I win too much too quickly, I become the crowd I used to read. He understood that consistency, not victory, is the measure of mastery. That's why he preferred steady growth to dramatic wins. Because steady growth preserves the geometry of calm, the human equation. Every trade, he said, has three variables. 1. Price what you think you know. 2. Time what you can't control. 3. Size what you choose to control. Price and time belong to the market. Size belongs to you. That's where responsibility lives. You can't blame charts, rumors, or luck for sizing. You own it fully, mathematically, morally. The market punishes the trader, who asks it to forgive bad arithmetic. Livermore's genius was that he made psychology accountable. He turned emotion into a quantifiable variable, the cost of comfort. Livermore believed comfort was a form of blindness. When a position felt too easy, he knew danger was near. He said, a comfortable position means I've stopped questioning. He treated anxiety not as an enemy, but as information. Mild discomfort meant awareness was alive. Overconfidence meant awareness was dead. He sized to maintain curiosity, never complacency. That's how he stayed rational in irrational markets. He designed his exposure to keep himself thinking. the ratio of clarity to chaos. He believed there was an invisible ratio in trading. The more noise you allow, the less clarity you have. Large position amplifie noise. Every tick becomes a thunderclap. Small positions amplify boredom. You lose engagement. The right size creates stillness, a zone where information and intuition coexist. That's why he called sizing a psychological instrument. And it's how you tune your mind to the right frequency of the market. Emotional leverage. Livermore often warned that the worst form of leverage is not financial, it's emotional. A trader with a large position borrows confidence from the future. He behaves as if profit already belongs to him. When the market contradicts that illusion, the collapse is not just financial, it's spiritual. He said, a man can recover capital, but never the illusion that made him lose it. Position size, to him, was a mirror reflecting how much illusion he could safely handle. When risk becomes identity, Livermore saw his greatest danger, not in losing trades, but in becoming his trades. He noticed that as positions grew, he started speaking in first-person plural. We're long steel. We're short cotton. That linguistic shift terrified him. It meant the market had merged with his sense of self. And once ego fuses with price, loss feels like death. He fought this by writing in the third person. The market is wrong, not me. That distance restored geometry. It separated the man from the moment. The emotional equation of control. Livermore summarized his philosophy in one quiet formula: risk, Chemp's emotion equals distortion. If either grows too large, you lose perspective. Reduce risk, emotion settles. Reduce emotion, perception sharpens. And perception, not prediction, is what makes money. He built his entire empire on that subtle arithmetic of awareness, the fourth secret of position sizing. The right size keeps your mind honest. That was his fourth great rule. He didn't size for greed or excitement. He sized for clarity. He believed the perfect position is the one that lets you sleep at night and think clearly in the morning. He never chased returns that cost him peace, because peace was the foundation of every profitable thought. Reflection for modern traders. Look at your current trades. Are they heavy or balanced? Do you feel focused or reactive? Livermore would say your body already knows. Your anxiety, your impatience, your distraction, they all point to one truth. Your size is wrong. Adjust it until you can breathe again. Then observe. That's the level where awareness returns, and profits follow naturally. Closing the fourth rule. Capital without calm is chaos in disguise. Livermore lived by that creed. He sized to think, not to thrill, because he knew that in the geometry of trading, the only line that matters is the one between awareness and emotion. As long as that line stays straight, no storm, no loss, no noise can break the structure you've built. The rule that outlives every market. The philosophy of position sizing. In the end, Jesse Livermore's genius wasn't that he made millions. It was that he understood why most men couldn't keep them. He didn't trade stocks. He traded himself. And his rules were not about markets. They were about human nature. Among all those rules, one survived every era, every bubble, every crash. Size decides survival. It was simple, brutal, and eternal. The law beneath every market. Markets change, technology evolves, structures shift, but the emotional math stays identical. Fear expands exposure beyond logic. Greed inflates risk beyond reason. Hope delays discipline until the lesson arrives too late. Livermore called this the law beneath the tape. He said, the market's face may change, but its heartbeat never does. Every generation thinks it's smarter. Every generation relearns the same law. That position size is the only variable still under your control. Everything else, price, news, time, belongs to chaos. The philosophy of control. Livermore believed control wasn't about domination. It was about cooperation with uncertainty. You can't control outcome, but you can control exposure. That one decision defines your identity as a trader. He said, the man who controls size controls himself, and the man who controls himself controls the market indirectly. He didn't mean you can bend markets. He meant that self-command changes probability. A disciplined trader survives enough cycles to meet luck more often. And in markets, survival is skill. The moral dimension of sizing. Livermore saw position sizing not just as math, but as ethics. Every trader owes respect to uncertainty. Overconfidence is a moral failure. The arrogance of thinking the world owes you profit. He wrote, "When I bet too big, I am not defying the market. I am disrespecting it." That humility kept him alive longer than his intelligence did. Because markets forgive ignorance, but they never forgive arrogance. Proper sizing, to him, was an act of respect. It was saying to the universe, I know I can be wrong, and I'm prepared for it. The cycle of humility and hubris. His life became proof of that philosophy. Every time he respected size, he flourished. Every time he ignored it, he fell. After the 1929 crash, he was wealthier than nations, and yet years later, he lost it all. Not through bad ideas, but through overexposure to good ones. He forgot his own geometry. He grew too large to see clearly. The same law that made him immortal eventually demanded its debt. His tragedy wasn't contradiction. It was consistency. The same pattern, repeated in reverse. That's what made his story timeless. It shows that the market doesn't change. Only memory fades. The timeless rule. If Livermore could distill his life into one principle, it would sound like this. The market can forgive wrong direction, but never wrong size. That is the spine of every modern risk model, every portfolio theory, every survival strategy ever written. He discovered it alone, without equations or computers. Just silence, tape, and discipline. And that's what makes it eternal. Because truth that requires no technology never expires. The paradox of mastery. Livermore's story holds a paradox. The more he mastered the market, the less he needed to trade it. His understanding grew deeper than the charts could contain. He realized that trading isn't about profit. It's about precision of mind. Position sizing was simply the instrument through which he measured that precision. He said, "Money is the byproduct of proportion. Find proportion, and you'll never need to chase money again." That was his definition of freedom. To act without compulsion, to wait without anxiety, to lose without breaking. The science of enough. Livermore wrote, "The man who knows how much is enough knows everything worth knowing." He believed that the purpose of sizing was not to expand endlessly, but to define enough. Enough position to matter, not enough to destroy. Enough confidence to act, not enough to forget humility. Every trader dreams of winning more. Few dream of needing less, but Livermore did, because he knew that needing less is what allows you to keep what you win. The modern reflection. Today, traders have infinite tools, real-time data, leverage, and automation. But the ancient problem remains unchanged. We mistake motion for mastery. We mistake exposure for expertise. We mistake confidence for confirmation. Livermore's rule still applies. Start small. Build proof. Scale truth. His discipline would embarrass our machines. Because no algorithm can replicate humility. Only a conscious human being can respect uncertainty the way he did. The last secret of position sizing. Capital is courage measured in percentages. That was his final secret. He sized his courage, not his greed. He knew courage must be rationed like air. Too little, and you suffocate. Too much, and you burn. He didn't trade to prove himself brave. He traded to prove himself balanced. That balance, between fear and faith, math and mind, is what turned speculation into art. Reflection for modern traders. Ask yourself, if your position disappeared today, would you still feel intelligent or empty? If your answer is empty, your size is wrong. Livermore would tell you, trade small enough to think clearly, and large enough to care deeply, because clarity without commitment is theory, and commitment without clarity is chaos. The art is in proportion, the legacy that survives. Livermore's rule outlived him, because it wasn't about trading. It was about awareness. Awareness that no matter how smart you are never bigger than your position. That's the humility that built his empire, and that's the humility that every trader must rediscover. In their own way, in their own time, in their own silence. The final reflection. When asked once what his greatest discovery in the market was, Livermore smiled and said that I don't need to be large to be right. That was the moment he transcended numbers. He turned discipline into philosophy and proportion into peace. His story ended in tragedy, but his wisdom didn't, because truth doesn't die when the man does. It only waits for another listener. Closing the fifth rule. Size decedes survival. Survival decedes legacy. Livermore's final lesson isn't about how to win. It's about how to last. Because lasting, in markets, in life, in purpose, is the ultimate profit.